complete guide and the complete blueprint of how to go about trading this simple strategy. So let's go and let's get it. So right here, as you can obviously tell, are the three things that I use. Okay, but we're gonna break down each one of them in simplest terms and as simple as possible, so you can understand everything there is when it comes to trading. So number one, and this is the first thing that you need when it comes to trading in the markets, is going to be market structure. Okay, you need to understand market structure. Now, what time frames are we looking for structure? It's going to be on the 15 or 5 minute, and for entries it could be anywhere from the 5 minute to the 1 minute. Okay, but if we want to identify structure, it has to be on the 15 or 5 minute. So that is what the first thing is that we have to understand is market structure. Okay, next thing that we're looking for is going to be supply and demand zones. Once we understand structure, we need to look for specific supply and demand zones. Okay, valid ones. Now, what is a valid supply or demand zone? A valid supply and demand zone is a candlestick that causes an impulse move up. Preferably, the valid ones and the ones that I like are the ones that cause a break of structure. So this would be a valid one, or a market structure shift. So those are the ones that I see as valid. So that would be supply and demand zone, market structure. So then after we get these, what would we be looking for? We would be looking for an entry model. Okay, so once we've identified structure, once price tapped into our zone, then now all that's left is going to be an entry model. Okay, so what entry model are we going to use in this case? In this case, we are going to be using four different type of entry models. Okay, but here's an example. Okay, so let's say market is bullish, then we know we want to look for demand zones. So then we see a demand zone right here, it's valid, and then once price taps in, then that's when we want to look for the last step. Okay, now there's going to be four entry models, like I said, that I use, and they're right here. These are going to be the four entry models that I use to enter a trade. Okay, so it's going to be a rejection entry, it's going to be a candle close entry, it's going to be a risk entry, and it's going to be a confirmation entry. Now you have options, but I'm going to break down all of these entries very quickly. Okay, so let's go on to a real chart and see what happened today. So right here is a great example, so I'm about to show you guys. Right here is a great example. Okay, because right here, what do we have on the 5 minute? Let's see, we have right here. Okay, so right here on the 5 minute, we have this low, and then we have this high, and then we have this low. But what happened? There was a market structure shift. It was right here, right? This was the market structure shift. Now, what was the candlestick that started that? It was this candlestick right here. This candlestick started that whole move up, right, causing that market structure shift. So this is going to be a valid demand zone. So now we're no longer bearish, we're bullish, and there's a demand zone, a valid one. So once price taps into here, this is where the entry model starts working. Okay, so once price taps in, you can enter a risk entry, and a risk entry would just be, or would just mean, if you enter right off the rip. So a risk entry would just mean if you enter right when it taps in. So let's say you enter right when it taps in, boom, and then your exit or your stop loss would be, let's say, right here, and boom, this would be your trade. Like, this would be the trade that you take, and this would be your entry model. Okay, so now that is risk entry. So you got an understanding of risk, what risk entry is. Let's go over a rejection entry, or let's go over a candlestick entry. My bad. So a candlestick entry would be on the 1 minute. I would go on the 1 minute, and I would wait for I would wait for the candlestick to close, but I would wait for it to close good. Okay, and what does that mean is that give me some sort of good close. Like, if we're bearish, if we're in a demand zone, I want this to close bullish with a good, like, convincing me with a good candle close. Okay, so this right here wouldn't be a good candle close because it's bearish. But this right here is a decent candle close, so I could enter right here. Something like this is even better. Now, for me, what is a good candle close? A good candle close is when there's a long wick at the bottom, because this is telling me that it no longer wants to drop and it wants to just reverse, or it wants to just reject off of that area. Vice versa if we're in the supply zone. But this is a great example of a a candle close entry, because I'd wait for this to close and then enter. Now, the next one is going to be a rejection entry. Now, what is a rejection entry? A rejection entry is when you wait and you wait and you see how the candle reacts off of that entry. And if it gives you a good rejection, then that's when you enter. And if it doesn't, then you don't enter. So in this case, the only difference between a rejection entry and a candle close entry is a candle close entry you're going to enter when the candlestick closes, but a rejection entry is you're going to wait. So you're not going to wait until it closes. You're going to wait, and then once you get that good rejection, then you're going to enter. Now, what are the benefits of a rejection entry? The benefits of a rejection entry is you could get a better entry. So let's say right here, it's rejecting and it's already giving you signs that it wants to shoot up and it wants to reverse. And I was to get in right here. This is a better entry because now I'm risking less. Plus, you're entering earlier. So you're kind of saving yourself just in case something like this happens. Because if something like this happens, it's a really impulsive move. Then what happens? You miss out on this trade and then you no longer enter it, because we all know if we trade in the markets, shit like this happens. So that's another thing. Candle close entry is still good because it's a little bit more secure, because now once it closes right here, you can get an entry right here and then risk this. But the only thing, like I said, I don't like about it is that, sometimes you might be risking more. You might be missing out. You might be missing out more than you were intending to. But that is going to be a rejection entry. I went over the candle close entry, and then I also went over the actual entry of the risk entry. So now let's go over the last one, and this is going to be a confirmation entry. So a confirmation entry is going to be something like this. So as you can tell, we already rejected, right? We already rejected off of that valid demand zone, but now a rejection entry would just be waiting for a 1 minute demand zone, valid demand zone on the 1 minute to appear, and then entering off of that. So we already have a valid 5 minute zone, but now all I'm looking for is a valid 1 minute zone. So in this case, boom, right here, just taps in. Let me fix this. Boom. So right here, this taps into this demand zone, boom, on the 1 minute, and it barely taps in, but for the example, we use it. And then once it taps in, you enter, because this is now you're risking less, even less, and you're getting more of a precise entry. So then boom, look at that. Boom. You take this trade, or you can use it on the higher time frame and then get out right here. But look at that. Boom. So those are the 4 type of entry models that I use. And like I said, it all started from these 3 things right here that I pointed out at the beginning of the video, if I could find them. But these 3 things right here that I pointed out in the beginning of the video, what was it? It was market structure, understanding that. Number 2 is going to be understanding supply and demand zones. And then number 3 is going to be the entry model. So once you understand market structure, right here we understood, because on the 5 minute we had a shift in structure. And remember, everything's going to happen on the lower time frame before it happens on the higher time frame. So that's something to keep in mind. And then number 2 is going to be a valid supply and demand zone. So right here we had a valid demand zone, and that's what we're looking for since the market is bullish. And then last step would just be entry model. And there was literally 4 entry models you could have used today. Like today was the perfect day. So this is why I wanted to give this example. But yeah, so these are the 4 entry models that you use. These are the 4 ways to go about looking at it, and that is exactly how you go about this. So other than that, like I said, if you have any other questions, feel free to leave me some comments down below. Feel free to like the video. I haven't posted on here in a while, but I'm going to keep posting. I've just been locked in. So yeah, new content on the way. And what I'm saying, just y'all let me know. Like, subscribe, and I'll be posting more.